Munro Climate Change Leaders Fund returned negative 13.8% in the March quarter, negative 9.6% from equities and negative 4.2% from currency, while the MSCI All Countries World Index in AUD returned negative 8.4%, negative 4.8% from equities and negative 3.6% from currency. The first quarter of 2022 has been difficult for global financial markets. What began as a growth equity correction escalated through February with the Russian invasion of Ukraine and concluded in March with a vicious bond market sell-off on the back of an increasingly hawkish Federal Reserve. From a stock attribution perspective, circular economy names with a focus on food agriculture, such as Nutrien and Deere & Co, were the key contributors, as issues in Eastern Europe have highlighted the need for greater food security and the importance of farm management to improve efficiency. Longer term, they're expected to benefit from resource scarcity and the shift to sustainable agriculture. The key detractors for the quarter included energy efficiency positions, Train Technologies, clean energy name, Air Products and Chemicals. Looking ahead, this is a highly uncertain time, but when faced with uncertainties, we continue to rely on the earnings growth of the companies we invest in to guide the path forward, as whatever happens in the world, we know that share prices follow earnings in the long run. In our market outlook, we see three common questions. Don't higher interest rates equal lower multiples for earnings growth? The short answer is yes. As rates go up, multiples go down. But importantly, interest rates can only go up so much. There is simply too much debt in the world for longer term interest rates to get much higher than 3%. But won't earnings growth suffer from higher interest rates and input costs? Again, the short answer is yes. Earnings growth will slow in this environment. The Fed is actively trying to slow the economy, and the reopening tailwinds are beginning to slow. However, the structural trends that drive our companies will endure. There are also new opportunities that have presented themselves in this uncertainty. Notably, renewables, agriculture and cybersecurity look to accelerate in this environment of scarce resources and geopolitical uncertainty. What if the war escalates? What if China invades Taiwan? Clearly, we don't have a crystal ball, and we don't know what the next big shock is around the corner. This is not necessarily an environment in which to be fully invested. However, we have worked over the past several months to improve overall quality, valuation and diversification of the companies in the fund, as well as screening to ensure we're comfortable with every company's balance sheet. In conclusion, we would encourage investors to take a big step back and look at where we stand in the landscape today. Equity markets have been strong for a long period. Volatility is here and markets could be difficult for a little while. In the end, longer-term interest rates are unlikely to move up dramatically. There's simply too much debt in the world. We remain excited about the opportunities presenting themselves, and we'll look to use this volatility to position ourselves for the months and years ahead.